Hi everyone, I'm Kingsley. Today I'm going to talk about what is accounting. Accounting is very important for any organization, may it be profit oriented or may it be not for profit. So whatever the objective organization has, accounting is very important because organizations are using limited resources to achieve their organizational objectives. If it is for-profit organization, they want to obviously maximize their profit. In order to maximize their profit, they want to use their limited resources more effectively and efficient manner. In this regard, they need to carefully make decisions regarding the limited resources. When it comes to not-for-profit organization, they too wants to utilize limited resources to achieve their welfare objectives. So whether it is for-profit or not for-profit, all the business organization and not-for-profit organization are utilizing limited resources. So they need to make their business decisions very carefully. In order to make effective and efficient decisions, you need to have reliable, accurate, and timely information to support your decisions. You cannot just make decisions based on your gut feeling. It may be sometimes correct, or you may be successful by making decisions based on your gut feeling. But in a competitive business environment, you may not be able to survive in the long run just by making decisions based on your emotions or your gut feeling. You need to base all of your decisions on rational, reliable, accurate, and timely information. So accounting plays a very crucial role in this regard. Accounting is the main mechanism that we have established in an organization to cater this information need of the management to support in making more rational decisions. But don't think it is only the accounting that provides information for the managers to make decisions. Now, for example, marketing functions or marketing people, they too have very valuable information generated from their marketing function. They have customers' feedbacks, they have market-related information, competitors' actions, their reactions, the product failures, and the customers' perception about the product quality. So all this information is there with the marketing management. When it comes to production team, they do have very valuable information regarding production functions, the quality of the products, the production processes, and the production cost related information. When it comes to HR division, they are managing one of the most valuable resources in the world, that is human resource, which brings an organization a competitive advantage with the core competencies that exist with this or that are embedded in their human resources. So even HR division, they have a lot of very valuable information. So we can see almost every functions in an organization, they maintain valuable, very important information that support management to make effective and efficient decisions. But as far as accounting is concerned, or accounting functions, accounting department is concerned, the role of information they play is very crucial because it is the accounting division or accounting function that looks at the organization as a whole. While marketing people might be concerning or worrying about marketing functions only, production department might be concerning on production process. HR function, they are looking at HR function, right? But when it comes to accounting, they look at the business as a whole. So they know how much of revenue is generated by marketing people, how much of production cost incurred by production people, what is the employee's salary, right? How much of money we need to maintain in the current account to ensure employees' salaries are paid, how much of money is needed to pay the government tax, how much of money should be reserved to meet our borrowers' obligations or the lenders for banking, how much of money is required to satisfy our shareholders to pay dividends. So all these key issues, key financial matters are managed, are governed or controlled by the accounting function. So accounting function has overall information base which are relating to both revenues and costs. So it is the accounting function that talk about the profit, because the profit is the difference between incomes and expenses. So accounting function looks at the business organization as a whole and they gather information about all the incomes, all the costs and expenses of an organization, and they can see what is happening to the business organization, what is happening to the profit of the organization. So management are highly worried about profit or the wealth of the organization. When the profit is generated, profit is maximized, the wealth is also maximized. Though there's a technical difference between profit and wealth, I'm not going to talk about it. Let's say, for the time being, the prime objective of an organization is to maximize profit. So who can talk about profit? When management is highly concerned about profit, it is only the accounting function that can talk about the profit. So accordingly, accounting function generate information that support management to make decisions. So we can say accounting as a process of identifying, measuring, and communicating of information to the interested parties to facilitate in making rational decisions. According to prime objective of accounting, we say, is to provide information to the interested parties. Right. If the objective of accounting is to provide information, there should be some uses of accounting information. As illustrated in this particular illustration, you can see the center yellow circle, you can see internal managers. Around the internal managers, we have a lot of external users of accounting information. For example, what I have put in red colors shows very crucial and very sensitive people about the firm's financial result and position. For example, existing and potential investors, they are highly worried about the company's investment they have already made or what is going to happen to their future potential investment if there's any. And lenders, they are the people who provide long-term capital to the organization, like bankers and other corporate fund providers. So they are highly worried about the company's financial result and financial position. On the other hand, there are suppliers and creditors who provide goods and services for the organization on credit basis. So they're too worried about whether their credit can be recovered. In addition to these people, you can see customers, employees, competitors, governments, other investors and general public or researchers, students. There are a lot of parties who read information, account information relating to business organization. Right. We now see, why do these people need account information? For example, if you look at the uh, existing and potential investors, they want to know about the profitability, the growth of firm, the risk and return of their investment. For the lenders like banks and corporate fund providers, so they want to know about the creditworthiness of the business organization, whether or not to lend to the relevant organization. When it comes to creditors and suppliers, they want to know whether or not to increase the credit period or whether or not to change their credit policy with respect to the business organization. Whether it's possible to recover the credit from the business organization. All these assessments can be made by reading the financial information or accounting information. In addition, employees, customers, government, competitors, all these people are highly worried about business organization, financial information. So we need to cater this information through accounting. So all these users of accounting information, we can broadly classify into internal users and external users. Internal users mainly represent board of directors and internal management. All the parties other than the internal managers or board of directors are known as external parties or external users of accounting information. These external users and internal users have different information needs. Internal users like managers, HR manager, marketing manager, or the production manager, IT managers, they have different information. At the same time, external users like researchers, customers, competitors, governments, potential investors, they too have different information need. But we cannot satisfy these different information need of all these internal and external parties. Now, when it comes to external users, like external shareholders, competitors, suppliers, even if they have different information need, we cannot deliver those different reports as requested by these external parties. So whatever information need they may have, right, we are going to produce some certain reports on common basis. So these common reports are known as general purpose financial statements. So in order to satisfy the external users information need, we prepare general purpose financial statements that are prepared on common basis, on general basis. So these general purpose financial statements are prepared through financial accounting. General purpose financial statements usually includes statement of profit or loss or profit and loss account, statement of financial position, statement of cash flows, statement of changes in equity, and notes to the accounts. So these are the 5 main components of a complete set of financial statements that are prepared mainly to deliver information needed of the external parties. When it comes to internal managers, they do have different information need, but as internal managers, they are in a position to demand whatever the report they want. Whenever they want, they can request this report from the internal management or from the accounting department. So the reports that are prepared specifically for the internal managers use, specifically addressing the information need of these internal managers, are called special purpose reports. These special purpose reports are generated by management accounting. So management accounting main concern is to provide information, provide special information, provide tailor-made information to the internal managers to support in discharging their management roles. For example, planning, organizing, implementing, monitoring and controlling of business affairs. That's how accounting has two main branches. Financial accounting provide general purpose financial statements, mainly 5 statements. These 5 financial statements or components of 5 financial statements are included in annual report and published so that external users has the access to these general purpose financial statements. But special purpose reports prepared for the internal management use never revealed to outsiders, because most of these management reports might include some strategically important information. So company might be willing to keep this information as secrets. Accordingly, we can define financial accounting as a process of identifying, recording, classifying, summarizing, and interpreting of transactions and events of an entity with the view of providing information to the existing and potential investors, lenders, creditors, and other stakeholders about financial result, whether the company has made a profit or not. If you sit for an exam, pass or fail, that's the result. If you run a business, the result is profit or loss. So financial result or financial performance represents or means your profit. Then financial position, how much of asset you have, at the same time how much of liabilities you owe to outsiders. Accordingly, what is your financial position, whether you have lot of liabilities compared to a total asset, according to whether you are financially weak or whether you are financially strong. That is your financial position. Then cash flow. What are the sources of cash inflows to the firm, and what are the avenues or areas where you have utilized your cash. In addition, we can talk about the changes in owner's equity. Owner's equity means the shareholder's wealth. So financial statement provide information about financial result, financial position, cash flows, and changes in equity. So this information, in order to provide this information, we prepare 5 main components of financial statement. Statement of profit or loss and other comprehensive income. This shows the firm's operating result, the firm's financial result, whether the firm is pass or fail, profit or loss, that is the result. Then statement of financial position, whether financially strong or weak. Short-term financial position compared to short-term liabilities, whether you have adequate short-term asset, so that you can easily pay your short-term liabilities when they become due, or whether you are in a long-term financial position, whether it is strong or weak. So this financial position is reflected by a statement called statement of financial position. Formerly we called this balance sheet. Even today's time we can talk about balance sheet, but for financial reporting purpose, the technical term we use is statement of financial position. So statement of cash flows, it reveals the sources of cash inflows for an organization. Cash flows might come from their day-to-day routine business activities like buying and selling. If you buy goods, you have to utilize your cash. If you sell goods or provide services, then you have sales revenue or service income. So this sales revenue or service income might generate cash inflows to the firm. So users of the information might be willing to know what are the main cash flows, from which sources company generate cash. You can generate cash like from this day-to-day routine transaction. In addition, by making share issues or by making borrowings from bank or by selling your non-current asset or fixed asset, you can generate cash. So cash flow statement tells how company generated cash during the particular period. Then statement of changes in equity, it represents, it shows how the owner's net asset, how the owner's wealth changed during the period. So owner's equity means the difference between total asset of the business less total liabilities. Total asset, let's say 100,000, total liability, let's say 20,000, then the difference is 80,000. That is the wealth available to the owners of a business. So equity is what is shareholders are highly worried. If the shareholders want to increase the equity, there are different ways of increasing equity. But most sustainable way of increasing equity is making profit. If you make profit, more and more profit, that profit is added to equity. So a statement of changes in equity accordingly reveals how the owner's wealth or owner's net asset change during a particular period of time. The notes to the accounts provide detailed information about the aforesaid four statements: profit and loss account, cash flow statements, statement of financial position, statement of changes in equity. All these four statements, maximum you have one A4 sheet or two A4 sheets. So they are very summarized. If you want to know about in detail, the information available inside this four summarized statement, you need to refer notes to the accounts. So notes to the accounts might contain sometimes more than 100 pages. So first four pages, first four reports, maximum maybe, let's say 8 A4 sheets. For sure it is less than 8 A4 sheets. But when it comes to notes to the account, we have detailed information to support you to understand what is there inside of the first four statements. So notes account helps you to understand the information which are available in summarized manner in the other four financial statements. So what is management accounting? Then management accounting mainly concerns about identifying, measuring and communicating of information to the internal managers to support in planning, organizing, implementing, and monitoring and controlling of business operations. So main objective of management accounting is to support internal managers in discharging their management functions. So management accounting provides timely, relevant, accurate, and tailor-made information to the internal managers to support in making decisions regarding planning, implementing, monitoring, and controlling of business operations. So guys, we now look at the key difference